All right, today we are diving deep into an accounting rule that, believe it or not, completely reshaped how thousands of companies look on paper. We're talking about a change that unveiled trillions of dollars in what you might call hidden obligations. And trust me, this isn't just about boring numbers. It's about transparency, and it's about a massive shift in how we all see corporate debt.
So, let me start with a little puzzle for you. Picture two big retail chains. They sell the exact same stuff, they've got the same number of stores, and they're pulling in the same amount of cash. For all practical purposes, they are identical businesses. So how on earth was it possible that before 2019, one of these companies could look way healthier and far less in debt than the other?
Well, the secret sauce was all in how they handled their real estate. See, retailer A, they leased their stores, while retailer B went out and bought them. And just look at the difference this made on paper. Retailer A looks super lean, really efficient, low debt, low assets. But here's the kicker. Their actual obligations, the real long-term promise to pay for those stores, were almost identical. It's just that one company's debt was sitting there in plain sight, and the other's, well, it was basically invisible.
And this right here gets us to the core problem that the entire accounting world really had to wrestle with. This massive, unbelievable amount of invisible, off-balance sheet debt. Before this new rule came along, all those long-term lease payments, we're talking everything from airplanes and storefronts to massive office buildings, they just didn't show up on a company's main financial scorecard, the balance sheet. Nope. They were tucked away deep in the footnotes. And this was a huge deal, especially in industries like retail, airlines, and telecom, where leasing stuff is just how business is done.
And that's what sparked what I like to call the Great Lease Unveiling, the rollout of a brand new global standard that was designed to drag all of this hidden debt out into the light for everyone to see.
So, on January 1st, 2019, IFRS 16 officially went into effect. And its mission? Well, it was simple but honestly pretty revolutionary. Give everyone a much more honest picture of a company's financial position by putting pretty much all leases right there on the balance sheet. No more hiding in the footnotes.
And just look at this table to see how profoundly this one rule changed, well, everything. It's like night and day. Before, a simple lease was just another operating expense. After, boom! It suddenly becomes a right-of-use asset with a matching lease liability on the balance sheet. The cost itself wasn't a simple rent payment anymore. It got split into depreciation and interest. Even the cash flows got reshuffled. I mean, you can see how deep these changes went. Literally overnight, companies suddenly looked a whole lot bigger and a whole lot more indebted.
But this great unveiling, it had a really weird, unintended side effect. It created what some people call an illusion of profit, especially when you look at one of the most popular metrics in all of finance. So, by yanking those lease costs out of operating expenses and reclassifying them, IFRS 16 gave an artificial boost to a company's EBITDA. Now, you probably know EBITDA. That's earnings before interest, taxes, depreciation, and amortization, is super popular because it's supposed to be a quick and dirty measure of a company's core cash-generating power. And why does that matter? Well, because everything from CEO bonuses to bank loans, even the price tag on a company can be tied to that number. So a higher EBITDA, even a fake one, has very real consequences.
But here is the catch, and this quote just hits the nail on the head. The company wasn't actually any more profitable. It wasn't making more cash. Absolutely nothing about the real business had changed. That higher EBITDA was purely an accounting mirage. It was just a matter of presentation.
So how do smart analysts see through this? Well, they do a pretty simple adjustment to get back to reality. First, they take that new inflated EBITDA number. Then, they subtract out the new depreciation and interest figures that the rule created. And finally, they add back the actual cash rent that the company paid. The result? A normalized EBITDA that lets you make a real apples-to-apples comparison.
And believe me, this isn't just some boring theoretical exercise. Think about the airline industry, where leasing multi-million-dollar jets is just the name of the game. For major carriers, their reported EBITDA jumped by billions of dollars the very day IFRS 16 kicked in. Without this kind of normalization, trying to compare one airline to another or even to itself from the year before would be totally misleading.
But while investors and analysts were pretty happy with all this new transparency, putting this standard into practice was a massive headache for the companies themselves. And that brings us to the high cost of all this transparency. For so many finance departments, especially the ones trying to juggle all this in spreadsheets, the complexity was just overwhelming. I mean, you had entire systems that were completely dependent on one or two people who knew the magic formula. Any little change, a new lease, an updated interest rate, meant hours of manual updates. It was a nightmare to verify if the numbers even matched the contracts, and the risk of a simple fat finger error just got bigger and bigger every day. It was a constant source of stress.
And this quote right here, it just perfectly captures that feeling of pure relief from companies that finally gave up on the spreadsheets and switched to specialized software to handle IFRS 16. It really shows you just how painful that manual process was and why finding a better way was such a game changer.
And this gets to the real heart of the debate. Even with better software, a lot of the companies that are actually doing the work, the preparers of these financial statements, they argue that the constant costs, the sheer complexity, and all the judgment calls they have to make are so high that they might actually outweigh the benefits of the whole thing.
Which brings us right up to today, because the fight over IFRS 16, well, it's not a closed case. Not at all. It's really an unfinished story, and regulators are now actively taking a fresh look at the standard's real-world impact. So here are the two sides of the coin. On one side, you have investors and other people using the financial statements, and they're basically saying, hey, this is working. We have better transparency, we have higher quality info. But on the other side, you've got the companies putting the reports together saying, we're not so sure this is worth it. The costs are huge and the complexity is a constant battle. And this timeline really shows you how current this all is. The rule became effective back in 2019, but the official review process just kicked off in 2024. And right now, as we speak, the International Accounting Standards Board is actively asking for feedback from everyone on how this rule is really working out in the wild.
This all boils down to the one central question that regulators, investors, and companies are all trying to answer today. Now that we've had a few years to live with it, is the undeniable gain in transparency truly worth the significant cost and complexity it created?
So, yeah, we're at a crossroads. The great unveiling happened, the debt is out in the open, but the story is far from over. As the rulemakers weigh all this feedback, the entire world of finance is watching and waiting to see which way the compass is going to point next. Will the standard get simplified? Will it be tweaked? Or will it be held up as a necessary, if pretty costly, step toward true financial clarity?